I think what we're seeing here is just a big reassessment of global risk, but obviously focused on the U.S., right? And we're seeing that discussion sort of jumping into the limelight about U.S. recession risks and just what the tariffs mean for global growth as well. There's a clear sort of fear, for lack of a better word, of just the economic prospects there right now, and we're seeing realignment there. We're seeing people just kind of taking a second look and saying, is this where I want to be right now? The general direction is kind of the way we see things going through the rest of the year. It's just all happening really, really quickly.
Well, on your point about growth and the concerns that have really escalated in the last couple of days, we had Mohamed El-Erian speaking to us earlier this morning, and he had some really interesting thoughts that the market is perhaps too focused on growth and not focused enough on inflation. Take a listen to what he had to say.
The market is underestimating the inflation side of what's happening. The first reaction has been concerns about growth, and that's totally understandable. We haven't had two other reactions yet. What will happen to growth in other countries? And that makes a question mark on whether the dollar weakness will continue. And then the second, what does the Fed do? I think that if we're lucky, we'll get one rate cut, not four, one, and it wouldn't surprise me if we get none.
Fascinating. And Mohamed saying he wouldn't be surprised if we don't get any Fed rate cuts. That seems to be very contrarian when you look at the market moves. What are your thoughts?
Yeah, I mean, look, I'll be honest, we're quite a bit more dovish than that. We do think the Fed is going to get to a series of rate cuts by the middle of the year, starting in July, and essentially cutting at most meetings, well, every meeting for the rest of the year. I think, there is a lot of uncertainty, right? For us, the inflation risks are absolutely there. If we kind of take the tariffs announced to date under the Trump administration, it's probably boosting inflation by about 1 to 1.5% in the U.S. It's quite a chunky number. But at the same time, there's the growth worries. And, if we map through what we're seeing into the growth space, this is probably taking about 0.75% off GDP by the end of this year. For us, the Fed is... what they want to do is look at the inflation formation from the tariffs, make sure that it's, proceeding as expected. And obviously there are these risks here that we've seen in the inflation expectations data already. But for us, it's still all about the labor market. It's about growth, and when they see some of the surveys that we've seen already, the weak surveys, if as anticipated that starts to pass through into hard data, we think by the July meeting they're going to be a lot more comfortable cutting rates, even in a stickier inflation environment.
And are you also dovish on European rates and British UK rates? I mean, we're looking at a massive change in bank positioning this morning. Investors seem to be really reassessing that banks trade here because of the outlook for growth and because of the outlook for rates. What are your thoughts there?
I think at the moment, from a retaliation point of view, when it comes to Europe, we're not really expecting much. The EU, from everything we hear, wants to negotiate before retaliating, so that's going to buy 2-3 months before we get any direct measures from this week's announcements that start to feed through the economy there. The UK, let's be honest, at 10% is basically at the global minimum. There's not much negotiating to be done because I don't think the U.S. is going to grant anyone below 10%.
Yeah, it seems like that was structurally set aside as something that's not going to change.
So for the ECB, our view was April and June cuts were always predicated on tariffs of around 20 or 30%. If anything, the 20% actually was a bit on the low end of our range, but it still gives me that confidence that April and June are on the table. They probably stop after that for the better part of a year plus. For the Bank of England, I think they're still going to get to sort of sequential rate cuts. They're on this quarterly path right now. I do think that some of the inflation and wage data, it's going to be very, very noisy for the next few months. But come sort of late spring, early summer, they're going to start to see a bit more of that underlying weakness that the U.S. is seeing and other economies, and start to cut at a slightly more steady rate through the middle of this year and into the second half.
What does this mean for equity strategy, European equities versus U.S. strategy? U.S. versus European equities for the rest of the year?
I mean, what we're seeing, or what we've seen so far this year anyways, has been sort of a rotation out of the U.S. into Europe. There's been a lot of optimism in Europe. The fiscal announcements that we had recently, it's a complete mind shift in a lot of ways. Now, We tend to, we think that's the right interpretation, but we do think the markets are perhaps over optimistic on what the EU will deliver on the defense and fiscal side. And we also have to be really careful about timing here. The tariffs are going to hit the EU effectively immediately. Any sort of counter tariffs we get, say in 100 days or by the summer, are also going to affect the EU economy. This fiscal stimulus, this defense spending, for us anyways, we just can't see it making a meaningful boost on GDP data this year. This is much more of a 2026 story. So actually, for Europe, there's probably a bit of weakness ahead before things turn better. Eventually, we're going to get there, of course, but it's going to be a slow slog. And on the defense side, there's a lot of uncertainty about who's actually willing to use the flexibility in the fiscal rules to invest in defense. You've got France, Spain, and Italy all expressing some form of skepticism. Germany obviously is on board with it. But it's not quite as clear-cut, I think, as markets
still a lot
are
of
thinking.
execution.